Good evening, everyone, and thank you for joining us at Mirae Asset Mutual Fund. So today we have joined, to take you through an quarterly earnings review for quarter four financial year 2024. So quarterly earnings, especially the Q4 earnings, are pretty eventful ones because not only companies deliver or report the earnings for the quarter season Q4 season, that is January to March for every year, but also they also report and review on the how their financial year or full year financial year earnings were. So to know more on the same, today we have with us Mr. Harshad Borawake, who's head of research and a fund manager with Mirae Asset Mutual Fund. Welcome, Harshad. So, right. So before I, give the platform to Harshad to take us through the whole earnings season, the first half of the year has been quite eventful one, right? It's June right now, and the 6 months have been quite eventful. Particularly, we had the general elections for India, and while the markets right now don't look as volatile as they were at that point in time, we saw markets going through a lot of volatility post the exit polls and also then again on the election day. However, if one has to see the Indian equity markets from a very long term perspective, it's how the strength of the economy is, it's how the strength of the companies, the corporate earnings, the of the Indian stock market is, that is what takes the center stage when it comes to market movements. So therefore, one can, say that, it's not the events which decide or dictate the market movements in the long term, but it's the strength of the economy as well as its markets, which, give you a long-term perspective on things. So another, while we said, long-term things and the strength of the market, another thing that happened for this financial year 2024 was that, corporate profit to GDP, a very key ratio used to determine a lot of markets globally as well as domestically, is at an all-time high for financial year 2024. That is at somewhere around 4.8%. So to put things into perspective, during COVID, this ratio went as low as, towards 2.1. And right now it's above its, 20-year long-term average as well, which is around 3.7. So this speaks, a lot about the strength of the corporates, underlying corporates of the in the economy. So while we talked about corporate earnings, where these earnings are coming from, what all are the pockets, what all are the sectors that it's coming from. So we went right back to 2019, that is pre-COVID, and we tried to see what all sectors were there that were contributing. Then on a financial year basis, year-on-year basis, have these sectors changed in terms of their deliverance to, or the, their contribution towards earnings. So what we saw is that while the weight of the sectors that would be there in, say, any index. For example, we have here taken the BSE 200 index. While if the sector is relatively heavyweight, it will have a good impact. It will have a larger impact than relatively to other sectors. But not necessarily that every time each of these sectors will be a contributing sectors or a non-contributing sector. So, for example, metals was a contributing sector in 2022, financial year 2022, while it was not the same story in 23 and as well as in 24, while it saw a little bit of recovery over there. Similarly, automobiles was not present in the scene till 2022 as a contributing sector. However, right now what we have seen is that it has significantly, if not significantly, it has relatively contributed to the earnings this year. So to know more on the same, that how the sectoral growth story from here, if could it be different or not, I'll ask Harshad to take us forward through it. And over to you, Harshad, now.
Sure. Thanks, Tanya. So, as you rightly said, fourth quarter obviously is one of the important quarter. Also, primarily, similar to second quarter, companies do report on a balance sheet as well as cash flows, and disclosures are typically better in the fourth quarter. Only drawback, it requires SEBI has allowed 60 days to report. So to that extent, when we do the review, so it's kind of gets delayed. Okay, let's start. So just to set a context, before coming to the actual numbers. So if you look at few trends within the quarter, let's say consumption demand. So consumption demand was slightly weaker, but nevertheless, rural seems to be bottoming out. On the other hand, if you look at credit growth, I think that was quite healthy at around 16% or so at a overall level. Property cycle, has revived and continued to do well. On the margin front, I think clearly companies across the sectors did benefit from, RMs remaining lower. So to that extent, gross margins were slightly better. So some companies did use that to boost their EBITDA margin. Some companies did use that to, do more spends. So everyone take, two different stand. Even metal prices are slightly lower, oil prices are slightly lower. So in all this context, if you look at the Nifty 50 earnings for the fourth quarter, so it was up around 12% or so, obviously lower than the last few quarters. But within that, I think the largest contribution were from five companies, so 72% of the incremental profits on a YY basis were driven by five companies. So two of them were banks, some were oil and gas companies, one was a metal company, and so on and so forth. On a full year basis, if you were to look at, so let's say Nifty 50 EPS, so this is one of the important number or number better to track because from the E's point of view. So FY24 EPS stood at roughly 1005 rupees. So it is around 24% YY basis. If you were to look at 4-year CAGR, I think this is trending somewhere around 16, 17% or so. So I think as we move forward, so let's look at how let's look at the color on a sectoral basis. Which sectors contributed highest in the fourth quarter as well as on a full year basis. So on the extreme right column, if you were to look at, so that is nothing but the weight of each sector in BSE 200. So if you look at fourth quarter particularly, I think the contribution in the growth was across the sectors, more so, capital goods, BFSI, auto, and then smaller sectors also did contribute to the growth in the fourth quarter. On a full year basis, again, I think autos, financials, healthcare, cement. So these are the few sectors which drove the earnings growth. So as Tanya, showed one chart initially where if you look at for 19, 20, 21, so it was only one sector, which is contributing to the earnings growth, which was financials. But as we move forward over the last 2 years and even in the coming years, which we'll speak in a minute, the earnings growth, according to us, will be multi-sector driven. So obviously some sectors will outperform, some will again underperform versus the expectations. But nevertheless, we do expect a healthy earnings growth. In the near term, also post this FY24 or 4Q results, in the near term, what clearly needs to be watched out for is how the RM trends move, or how the monsoon, which is expected to be normal or better than normal, and obviously the budget post elections. Now the full budget will be given by the government. We need to look at these few trends which will dictate overall corporate earnings. Now let's look at sectors. We have covered a few sectors, not all the sectors in this presentation. So let's start with banking. So obviously it is one of the largest sector within the BSE 200, and also it is one of the largest across the portfolio. If you look at multi-sector pure equity portfolios, it's one of the largest. So I think during the quarter, again, as I said, credit growth was strong. 16% for the banks, particularly, it was more driven by retail and SME. Coming to profitability, I think NIM was largely stable. Deposit repricing, seems to be largely behind now. While there was some increase in the OPEX for the banks, but I think credit cost or the asset quality continues to be very good. So credit cost continues to be benign. So that all put together, ROA, ROE trends are much better, decent ROE performance across the banks. So I think for the fourth quarter, particularly, if I have to speak with, I think the PSU's profitability growth was ahead of private banks. I think going forward, while there is a competition in terms of deposits. CD ratios are higher for the banks. So to that extent, banks will have to be selective in terms of where to grow. But I think all put together, credit growth will continue to remain, I would think, a decent number. And valuations, particularly for the banking sector, I would say, is quite reasonable. So next we'll cover NBFCs, non-banking financial companies. So here again, I think the highlight again was continued strong growth during the quarter. So almost, if you look at overall AUM for the NBFCs, which is slightly wide-based, cohort, which includes housing finance companies, auto finance companies, microfinance companies, and also gold financiers. So all put together, I think as a whole, the AUM was roughly around 20% or so. Within that, I think housing finance had some yield pressure, while the cost of funds was high. So the names for the housing finance was slightly in check. On the vehicle side, I think stable names, again, driven by strong demand, more so by utility vehicles and two-wheelers. I think except MFI microfinance and within microfinance, also within some geography, except that, I think asset quality was much better, across the NBFCs. Going forward, I think we do believe that, if you look at the next 18 months, the expectation is that cost of funds or interest rates will are expected to go down. And if you look at typically for the NBFCs, a large part of their loans are fixed rate loans. So to that extent, I think from the NIM perspective, they would benefit in the medium term. Now, insurance again, important sector, still continues to remain under-penetrated. To that extent, I think a penetration story for insurance is quite strong. Within that, if you have to look at both general insurance and life insurance, so let's first look at general insurance. So here, I think premium growth slightly slowed down now in a higher single digit at around 9% or so, versus last few quarters average of around 13% or so. Within that, I think if you look at motor OD, where I think there was some pricing discipline has come up in the last 2 to 3 quarters, so which kind of helped them to report better loss ratios. Again, I think despite no price hike allowed by RDA for the last 3 years or so, motor TP loss ratio also, kind of still improved. And particularly if you look at group health continues to be a drag, I would say, from the overall loss ratios, given that obviously one of the reason is the healthcare inflation on that sector. Coming to life again, VNB margins continue to remain weak. One is product mix, which is one of the reasons, given that there is a pressure on non-par margins. One of the reasons was obviously some adverse decision on the budget where you high ticket insurance did get impacted during the last quarter. Overall, I think total AP was kind of muted at around 10% or so. But as I said, on the insurance side, all these quarterly numbers or quarterly things are, I would say, more of a noise. I think this overall, under penetration story is what one should focus on the insurance. Fourth sector I think we'll cover is pharma and healthcare. Pharma, as you know, for the last 12 months or so has been reporting good numbers. One of the reasons for that, is the pricing pressure in US coming down. So if you look at the US, just now there is a lot of, I would say, there is the drug shortages in the US. They are kind of reducing the pricing pressure in the US. So margin on the US front and growth on the US front is much better. Coming to India domestic side, I think in particular the listed pharma companies, they are growing ahead of the overall market which is growing at, let's say, higher single digit. They are growing better versus the markets. But overall, I think net, I think sector has done well over the last 12 months. Even going forward, I do believe that given that US is one of the large part of their earnings, and that will, I think, continue to do well. Within healthcare, two parts we have covered. One is hospitals and a second is diagnostics. On the hospital front, I think steady performance. If you look at average revenue per bed was up at around 10%. I think the trend in terms of average revenue per bed, I think that continues to remain steady. Hospitals continue to go through both organic as well as inorganic growth. We have seen a lot of M&A activity in the sector, and going forward also it will continue. On the diagnostic front, again, I think good growth, double-digit, 15% growth. Here, I think what has changed is that incrementally the competitive pressure has gone down more so from the new online players. So to that extent, large part of this 15% of growth was, volume-driven growth. So here again, I think both organic and inorganic opportunities will continue, and companies will use both these methods to grow going forward. Diagnostics particularly are focusing on going through a more geographical expansion. IT again, a global sector. Frankly, it has little correlation what happens in India or domestically. So IT has been weak for quite some time, more so because of challenging environment on the US side, where if you look at the projects are going through softness. I think even the fourth quarter was no exception for that. There is a clearly a disconnect between the order wins and the revenue growth which is there. So to that extent, I think that will continue for some time. Even if you look at big sectors like BFSI, consumer or communication, so they are again reporting a muted growth. From the guidance point of view, I think the companies have reduced the growth guidance going forward. Margins too are slightly, remaining subdued. So one of the trend from the growth point of view is the hiring. If you look at the chart on the right hand side, the hiring trends or its absolute QOQ increase in the hiring. So that has turned negative in the last few quarters. Within tier one and tier two, I think clearly the gap in terms of growth of tier one and tier two has moderated. So earlier tier two is growing much better than tier one, but I think that gap has reduced meaningfully. I think for now, we'll have to wait till the second half of this calendar year, or maybe we'll get some clarity post US presidential election in terms of growth for the sector. But for now, I think subdued growth trends is what I think will be there for the sector. So auto and auto ancillary both, if you look at typically India, historically, we have this 2 years of upcycle, 1 year of down cycle. So this time around, I think down cycle kind of got extended because of COVID. Coming to fourth quarter again, I think if you look at overall auto volumes, they are quite healthy at around headline number of around 20% or so. Within that, two-wheeler growth was highest at around 26%. Again, driven by the premium volume growth. And again, SUV or penetration of SUV continues that to grew by around 26% or so. Other like CV declined around 4%. So CV upcycle was ahead of both passenger vehicles and two-wheeler. Tractor was vehicles which the volumes declined around 16%. I think that was primarily because of the erratic monsoons last year and rural remaining weaker. If you look at value chains, first let's talk about OEMs. I think they reported strong, growth, primarily driven by product mix and also benign raw material prices. Auto ancillaries again good volume growth, drove the earnings for them. Tires again, I think they were some impact was there because of EPR provisions, maybe around 1% or so on the EBITDA margins. Export, I think, is strong, but one of the largest export area, which is Africa, so which is slightly weaker as of now. So for now, I think for the auto side, while I think upcycle will continue for some time, particularly in the two-wheelers. Passenger vehicle is while weak in the near term, but more importantly, I think what needs to track here is the raw material prices. If the raw material prices were to remain benign, I think then they can continue to report decent margins going forward. FMCG again, as I said, on the consumption front, consumption story has been weaker, but I think the positive part is that there are some green shoots. Companies had called out, some companies have called out that rural seems to be a bottoming out and is expected to do better. Here again, I think gross margin was boosted in the quarter, driven by lower raw material prices, but many companies used increase their A&P expenditure, but that led to kind of EBITDA margins remaining kind of capped. Food growth has slightly slowed a bit. Now has converged with the non-food kind of growth, but I think with macros largely remaining steady, monsoon expected, to be normal. I think we do expect that recovery in the FMCG should come by this year particularly and should benefit all the companies going forward. Retail again, it's retail while it's quite diversified, which includes QSR, paints, footwear, even some people put building materials into this, and then beverages and jewelry. So I think if you look at the trends at a headline level, I think retail, is weaker, but I think its story is, two-third and one-third, I would say, in the fourth quarter. The first 2 months were weaker in the retail, but in the March, from the commentary point of view, we did see uptake in quite a few sectors in the March month. But overall, net, I think 4Q was slightly weaker, particularly, on the QSR front, paints and, footwear, as we witnessed, there was some weakness. Jewelry, I think, did better, in the fourth quarter. I think the K-shaped recovery while it has slightly come down, but K-shaped recovery continues on the retail front where premium, consumption is still doing okay, but the mass consumption, again, partly to do with inflation, has got, impacted. Like for like, I think, as I said, in the Jan and Feb, like for like, it growth was slightly lower, but in the March, it kind of improved. During the quarter, many companies, if you look at the net store additions, was slightly lower than the earlier few quarters. Because I think there is a lot of rationalization exercise which was taken up by multiple companies. So to that extent, net store addition was kind of muted. But here again, I think we do expect main reversion to happen. Second half of this financial year, again, second half primarily because again we have a lot of festive seasons in the second half. Fourth quarter is also impacted by lesser marriage days. But I think going forward in the second half, we do expect recovery in the overall demand from the retail front. So oil and gas again, at while the broader level, sector is going through flux. Primarily, over the global front, there is a penetration of EV. There's a focus on renewables. But nevertheless, from the near-term point of view, I would say for the next 5 to 7 or 10 years, I think the conventional energy will continue to remain one of the highest, in the energy basket for any country, including India. So from the fourth quarter numbers point of view, I think upstream was largely steady, while oil was down marginally at around $83 or so. Similar realization post-tax, that's what companies got. APM gas price realization was kept at around $6.50. So steady numbers from upstream. From the OMC side, I think, marketing margins were quite strong, but there was weakness on the GRM front. And also the discounts from the Russian crude were slightly lower. So to that extent, the refining margins were again lower during the quarter. On the CGD companies, I think if you look at their gas input mix, so you have APM gas, which is lower price, and you have LNG. So the allocation of APM gas, continues to remain lower, and going forward also it will continue to remain low. So to that extent, they have to buy higher LNG. So there, I think the cost for the CGD companies will increase going forward. And from the volume point of view, steady volume at a country level, I think CGDs are growing anywhere between 10 to 12%, or some, the 8 to 12% kind of range. Petrochemicals, I think, while there was some improvement on a sequential basis, but again, margins continue to remain weak. I think story in the oil and gas sector for now is largely steady from the conventional numbers point of view. But if LNG prices were to remain low, then I do believe that the gas consumption in India should improve. And then there are also some talks of inclusion of natural gas into GST. So net that should also benefit the overall gas consumption in India. So real estate again after 10 years, as we also said last time, after 10 years, sector has come back. Last 2 years, we are seeing the upcycle. If you look at the project launches, particularly the last 2 years or so, so there is a premiumization which is happening, particularly post-COVID. People do want bigger houses. So I think that's the reason we are seeing premium houses being launched. That also results in higher realization growth. So for the full year, there's almost 11% growth in the realization for real estate companies. From the quarter point of view, while the launches were higher, but collection efficiency was slightly lower. Initially, because the initial token money is slightly lower, but I think going forward, we do expect collection to improve as the construction progresses. Net, I think sector should continue to do well. Inventory levels currently are at only 12 to 15 months, so that should again drive both launches as well as pricing to some extent. Corollary to I think real estate upcycle is other beneficiaries, typically late cycle beneficiaries like let's say tiles, paints, plywood, FMEG. I think all of the other building material or FMEG companies should also benefit down the line because of the real estate upside. Industrial and capital goods, again, if you look at last few quarters, more so last, I would say at least 4 to 6 quarters, we are seeing upcycle in the order book. So this quarter also the order book for the universe is also more than 7 lakh crores. But I think there was some slowdown in the execution during the quarter. One of the reason was some disruption in the global supply chains or some war which is happening on the Israel side. So there were some delays in terms of supply. So that has led to also trim the revenue guidance for some companies. But I think the broader story remains is that one, the capex cycle or the capex intensity from the government continues. Second, I think indigenization in terms of defense side continues. So that is also one of the subsector which is benefiting within the capital goods or industrial. Thirdly, I think as in overall industrial utilization moves towards 80% or so, we do expect private capex to come back. So maybe over the next 12 to 18 months should happen. In this quarter and in the near term also, there was some support from the lower commodity prices from the margin point of view. So as long as I think the commodity prices are in check, there should be a margin support, for the industrial and capital goods sector. So before we move to valuations, I think some sectors which were not covered, one is metals. I think that continues to within that. I think non-ferrous continues to do well. Ferrous obviously will be function of what happens on China. Telecom again, I think given that it's largely a 2.5 player market, while the third player is also getting back on its toes. But I think there again we are awaiting the tariff hike which happened almost 3 years back. But except tariff hike also because there is a change in the mix towards postpaid, so ARPUs are inching slightly higher. And the balance sheets of these companies are getting better with expectation of free cash flow going forward, but large part of capex is done. On the cement front, I think the fourth quarter was better, but I think in the near term there could be some slowdown because of monsoon or so. Margins are largely okay for the cement front, but I think on the pricing front we need to watch. So there's not much to cheer about, at least in the near term. Over the medium term, we'll have to see how the pricing moves on the cement side. Now let's look at valuations more so for the large cap, mid cap, and small cap. So the top chart is the long term, P 1 year forward P chart for Nifty 50. So right now it is trading at around 20 times 1 year forward, which is largely similar to, I would say, long-term average. But more importantly, on the bottom right side, if you look at small cap valuations, are trading at meaningful premium to long-term average. Mid cap too is trading to premium to long-term average. So in this context, we do believe that it makes a lot of sense to remain invested or remain higher allocation towards the large cap names. So how are we positioned across our funds? So just a snapshot of that. So while there are some funds where there is a where we have to be compulsory in mid cap or small cap, but funds like let's say ELSS where we are almost 66% of large cap, or let's say within Flexi Fund where we have 70% of large cap. So similarly we are also positioned towards large cap in our funds right now. Sectoral funds, again, they have their different mandate, but within BFSI or consumer also more than 60% aids towards large cap names. So hybrid funds, so we have different hybrid funds, right from conservative to aggressive hybrid. So conservative typically, which has 35, 37, which is equity savings fund, 35, 37% net equity. And on the aggressive hybrid, net equity is 74, 75%. So here again, I think the returns basically are driven by two factors. One is what is the equity percentage, and second is within equity, what we buy. So within equity here also, we are large cap biased. And one is obviously the investor profile, but secondly, right now, given the valuations, we have higher allocation towards the large cap. Yeah. So to summarize, while in the last few quarters we did saw divergent trends in terms of quarterly growth, but nevertheless, I think decent growth in the fourth quarter. Post the fourth quarter, if you were to look at forward estimates from the Bloomberg consensus, I think not much of a change. I would say earnings estimates largely remain stable. Broader story, if you were to look at from the India point of view, while India is one of the fastest growing market, but more so political and macro stability is very much there. So current account deficit, inflation, for forex is largely, I would say, in control. A fiscal deficit too, I think government has focused to contain the fiscal deficit. So macro front, I think not much to worry. Coming to corporate side, I think if you look at a few levers or growth drivers, the manufacturing through production link incentive scheme, housing. If you look at the corporate balance sheet, is one of its best. Banking balance sheet is also one of its best. Some trends like formalization or demand for discretionary that continue. So there are multiple, I think, growth levers from the corporate earnings point of view in the near to medium term. Over the longer term, I think from the India story remains that demographics are favorable with 60 to 65% of our population below 30 years or so. Spending on infrastructure for the last few years, everybody is witnessing that. I think benefits of those infrastructure spending will continue. Big reforms have been done. I will not go into details. So big, large reforms have been done in the last few years. So benefit of that, and more so all this coupled with digitization as a backbone. So I think the longevity of our growth from the India point of view is very much there. From the equity markets point of view, while markets have done well in the last 1.5, 2 years or so, but within that we do believe that allocating higher towards large cap makes a lot of sense because growth outlook is healthy, valuations are near long term averages. So what we believe where one should allocate more is one can prefer large cap, flexi cap, multi cap, or hybrid funds within that. Hybrid, there is a flexibility for a fund manager where he can change the equity percentage depending on the market valuations. And within thematic, we would say that one can prefer consumption given the penetration story, and BFSI given the valuation as of now. So I'll just take a pause here, and yeah, if anyone has questions, we can take those. Thank you.
Right. Thank you so much, Harshad, for providing us such a valuable insight and, sort of a wrap up on the whole quarter four financial year 24 earnings season. So one question that, I have from you is that, even for global markets, globally also it was the first quarter. They are on the calendar year basis. So for 2024, it was first quarter for them as well. So if you have to compare both the markets, how did India perform vis-a-vis global? Could you, is there a comparison, so to say, how were they versus how were we?
Globally, Estonia most of the market movements, and like we say, global orders moving to US, which is important. So there are tech companies are the one, which are driving learning and the index movement within that. So tech has a large portion, like the important role to play out here. I think that's not the case in India. So as you know, as we also showed in quite a few charts, the earnings growth for India is not driven by one or two sectors. It is a broad-based earnings growth. In even sectors like cyclical sectors as well as structural sectors. I think both the sectors are contributing in terms of. I think that is the one difference which I would say, in terms of corporate earnings growth between global and India. But I think the bottom of it is, India as an economy growing anywhere between 6 to 8, potentially can grow higher. And other global developed markets are growing at very low single digit. I think that is what the crux is. Depending on that, then the corporates within that will grow at that pace.
Sure. So viewers, I would request you all if you have any questions, you can, type in into the Q&A section. So we have received a few questions. So first being that, the union budget is supposed to be tabled in the month of July for the new government formation. So what are your expectation on the same, particularly with the, in respect of sectors that you have covered?
Incumbent government continues to be in power, while it's in different form. So I don't see too much of a change in terms of budget allocations. Maybe they'll have to make some room for allied with the government in terms of full allocation towards one or two states. That could happen. But I think the focus on indigenization, focus on infrastructure, I think that focus will continue. Broader themes like boost for manufacturing. I don't see much of a change on that front. So frankly, I think budget from our point of view, we do expect a continuation of earlier policy reforms from the corporate point of view.
Sure. So another question is that, what is your view on the whole PSU theme or the PSU sector, the public sector, enterprises sector? What's your view on the same?
So sector has done quite well. So no doubt about it. But eventually, the way it works in the equity markets is eventually it will boil down to whether the company is generating free cash flow, what are the ROEs, ROCs, and combination of that on the valuation. So within that, I think with the same parameter, be it PSU, be it private, it doesn't matter. As long as companies giving decent growth, as long as valuations are reasonable, I think they should continue to do well. If you talk about our process, the way we look at it, the company should grow, and there should be visibility of at least a double-digit growth for the next 5 to 7 years. Post-tax ROE should be at least 12%, and then the valuation should be reasonable. I think PSU, no PSU, frankly, I think as long as you fit in these parameters, I think the stocks that should do well.
Sure. So there are quite a few questions on the defense sector that, there's been a run up in the same. We have seen a run up in the same, it's been believed that, this sector could do well provided government backing, while the concentration is relatively present in the sector. But what's your view sort of on this sector from a long-term perspective?
See, again, I think sector obviously has done well because government focus is to produce more within the India, more more domestic production. And also recently, as we recall, there is a lot of global conflicts to that extent. Many countries also do want to, produce locally. So that is a theme which has been followed also in India. So defense companies are benefiting. I think in terms of order books, whatever we hear from the experts, I think order books will continue to remain healthy. Obviously, we'll have to see what are the capabilities of these companies in terms of fulfilling the order book. It's just not about having the order book number. It is also about what the execution is possible. If you look at fourth quarter, which went by, I think I touched upon that. So even in the satellite defense, and also there was some issue in terms of execution because of some part of it is also depending on the global supply chains. I think those things one needs to keep in mind. But I think from the theme point of view, from the overall outlook point of view, even we continue to remain positive on this theme. We do believe that government should continue to give more and more orders to the domestic companies. But obviously, all this has to be put in context of valuation. So it depends on how much you are paying for that. So we will buy or we typically buy up to a reasonable valuation, but not by a heavy price. That should be the thought process which one should use while investing in defense areas.
Sure. So there's another question, your view on the commodities, namely gold, silver, and crude oil going forward.
See, frankly, I'm not expert in commodity prices per se. All these commodities have their own different cycles. But most of I think typical behavior of these commodities is hardly it has to do with fundamental demand supply of these commodities. So case in point, let's say oil. So cost of production for oil in some countries could be $10, some countries could be $40, but the price is at 70, 80 or wherever it is. So there is some risk premium or political risk premium which is attached to that. Coming to gold again, similarly, it's not about what is the production cost. Typically, which happens in normal other commodities like metals. So here again, it is gold because it has other usage in terms of storage value. Typically, when things start to go more uncertain, people use gold as a hedge within that. So from the outlook point of view, I think one on the oil side, while at a longer term, there is an issue in terms of people moving towards renewable. So maybe oil, as a percentage of basket will continue to grow, be lower. In longer term, oil may not go that high versus history, but you really don't know the commodities. Gold for now, I think what we believe that if you look at history, typically, when the interest rates go down, gold as a commodity does well. So now, if you look at the outlook from the interest rate point of view, I think interest rates are expected to go down over the next 20 to 18 months. So I really don't know what will happen in the near term. So in this context, I think gold as asset class should do well. But again, just to caveat, commodities, frankly, don't really know this one.
Sure. So with that, any summarizing comments you have, Harshad, on the whole, quarterly earnings thing? So now the commencement of new financial year 25 has begun. So anything you have to say that, what factors, what trends you saw in, the quarter that went by that could give you an understanding, while no one can predict for sure, but give you an understanding of, what's about to unfold in the coming quarters.
No, I think more than the fourth quarter results, I would say, behavior of corporate India, particularly in the last 1 to 2 years, that is quite commendable. So all the earnings growth which we saw in the last 2 3 years, corporate India has used that cash flow to strengthen their balance sheets. So if you look at many sectors, which used to have typically high debt to EBITDA, debt to equity, those sectors, like let's say for example metals, those sectors even are talking of being net cash or cash rich kind of thing. So corporate India in the last 2 years has become much better from the balance sheet point of view. Banking sector has done its cleanup act in the last 2 to 3 years. If you look at capital adequacy ratio for the banking sector is quite strong. Thirdly, from the quarterly earnings point of view, while there can be ups and downs in some sectors across, but nevertheless, I think decent double-digit growth, which is what we are seeing. Obviously, in the near term, one needs to look at commodity prices and how it will have an impact on margins. But at a broader level, I think with India growing at, let's say, upwards of 6-7%, with corporate India Federation going towards 80% or so, government partly has done its part in terms of infra investment over the last few years. I think now is the time for the private capex to come back, over the next 12 months or so. So I think strong balance sheet will help to do this capex going forward. Valuations obviously on 1 year basis are not cheap, but typically what will happen is 1 or 2 quarters down the line we'll start, often the valuations will roll 1 year forward. So there again valuation will start looking reasonable. So in the near term, we do believe that there would be some time correction, but nevertheless, over the medium term, one can get decent, money in the equity point of view.
Sure. So thank you so much, Harshad, for such great insights. So this is, I believe, in a series of quarterly earnings webinar. This is the second series that we are doing. So looking forward to more of them. And thank you so much, viewers, for joining us and asking such interesting questions. So have a good day, everyone. Thank you.
Thank you.